And as we all know that day 2 today is all about building a financially inclusive future, Vision 2025. And yesterday, of course, we talked about the now and when about the industry. So the next panel discussion is about the power of predictive analytics and artificial intelligence in enhancing customer experience in the fintech ecosystem. And for this, I'd like to invite our moderator, Mr. Yashoraj Tyagi, on the stage. He's the Chief Technology Officer and the Chief Business Officer, Cash E. Our speaker, Ms. Seema Prem. She's the co-founder of FIA, that is FIA. And Mr. Gautam Bandyopadhyay, who is the CEO and co-founder of Trustt. Can we please give it out loudly for them, ladies and gentlemen? Over to you, Mr. Yashoraj.
Hi everyone. Good morning. It's again good to be back on the stage. I was just here in another panel on the other stage yesterday evening, moderating another great session. I was here last year as well. The last year's edition of this event in Delhi. So it's always good to be back here speaking, and it looks like a good fireside chat to have here with my esteemed panelists. So just before I get into the introductions, which have already been done pretty much, I'd say that this topic is like very relevant to all of us in this ecosystem, right? Because customer experience is something you just can't compromise with. It has become the center stage of everything you do. Later on, earlier, 20 years back, it used to be an afterthought, right? You build a product, you build a great stellar feature, and then you focus on, okay, how do I increase my customer experience? I focus on, great off-screen experiences, great on-screen experiences. But now, the world is beyond that paradigm. We are at a stage where we are just at the zenith of the amount of data we access at a consumer level, which isn't, and that is for a range of things. That is for, doing our own analytics, upsell, cross-sell strategies, feeding into those next generation credit scoring models out there, building the best recommendation engines out there. But really, what is it, what is it the customers expect then? They know that they are giving you all these data sets, but then they actually expect you to actually then know a lot about them and then offer them a curated experience. And that's why customer experience has also become paramount. Secondly, competition has heated up. These domains that we operate in are not just one-player games anymore. There's a whole ton of people out there trying to push the boundaries in innovation, and hence, for you to stay ahead of the curve in customer experience also becomes important. So with that note, by way of introduction, I'm Yashoraj Tyagi. I head tech and business at Kashi. We are a 7-year young credit-led financial wellness platform in the domains of credit investments and insurance today. Our bread and butter is the credit focus that we have, in which we actually rely on alternate data coming from large swathes of customers, and then running proprietary models on that to basically go ahead and serve the underserved and underbanked customer segments in India today, and then use the same data to offer them a highly curated customer experience when it comes to making financial choices for them. So with that, I'll move on, and I'll ask my fellow panelists here. Before I actually dive in, I think all of us have had this journey in terms of how do we curate our own customer experiences in our own enterprises. And would love to know from you guys in terms of what do you think has been the biggest delta that use of predictive analytics and AI has brought about in your sort of organization when it comes to really improving customer experience, and in which segments has that impact been seen the most? So over to you, please. I think you know to turn that on. Yeah, now should be fine. Do you want to?
Yep, sorry. Yeah. Can you hear me? Yeah. So I'll just explain my business model first. We set up banking outlets on behalf of banks across the country. So we in unbanked areas, and then we bank the unbanked in these areas. So the agents that run the banking outlets are called banking agents. So we have about 30,000 banking agents. So Uri, Kargil, Kedarnath, Kutch to Kanyakumari, you'll find a FIA banking center. And we serve around 32 million customers. So we deal with tiny transactions, $20, $30 transactions, but big data. So in our journey as a FinTech, impact FinTech, we realized that we have to actually monitor the performance of our agents across the country to ensure that they are not doing fraud, because we deal with the unbanked, which means they are extremely vulnerable and extremely low literate settings, resource poor settings people are working in. So we had rule-based algorithm models which ran in order to predict whether our agents are committing fraud. But over a period of time when the data became very big, we reached a performance plateau and the exceptions became higher. And that's when we got into machine learning around 7 years ago. And that was transformational for us. So sitting in our head office, which is in Gurgaon, I can actually predict what is the performance of my agent in a very remote location like Andaman and Nicobar Islands, and also whether the agent is committing fraud. Now, when we did that, our exception percentage from some 15 to 16% came down to about 4 to 5%, and now it's around 2.6%. So the advantage of that is, even though my revenues have quadrupled, there's been very, very marginal increase in addition to the risk management team, because the entire thing has been automated. And this becomes very important. So one, because we deal with public money, and public money of some of the most vulnerable people. So it's very important for me to actually proactively identify and detect this fraud in order to minimize the instances of fraud. And especially when you're dealing with money of very, very vulnerable people. So for us, that has been hugely transformative. The second area which Yashraj was talking about is we also have alternate credit scoring models. So we use the data on the banking data, the banking transaction data from our banking agents, and we predict for people who have no credit history or a credit invisible, and using alternate data sources, what is the credit worthiness of the individual so that we can lend to them. So which means that we deal with financial exclusion. So over a period of time, we have been able to bring large swaths of people into the formal credit system. So so we give them income generation loans, which means creation of wealth for them. We also have robo-advisory engines which enable them, advise them, people from these extremely low literacy situation, on wealth management solutions, on the right products to lend in a completely automated iconographic manner. So which leads to further financial resilience. So for us personally, we have realized that we had an opportunity as a company, not just to run AI on the periphery, but actually embed it in every aspect of our business. Yeah, thank you.
You can just take that. I have a caller mic. Good.
Yeah, hi. Yeah, I think my name is Gautam, and I'm the CEO and co-founder of Trustt. So as a company, we are building technology platforms that leverages AI and predictive analytics, okay, for powering businesses like Seema's. But Seema, it was very nice to hear in terms of how we have been able to use AI, to reduce the fraud rates from 15% to 2.6%. Okay, and it's a very vulnerable part of the society that we are dealing with, right? Okay, and so I'll just come back to in terms of how these technologies are really impacting, and it can have transformative impact in terms of how it can help you transform your business and make your risk lower, make your customer experience better. But since the topic today is about customer experience, I'll tell you a story. Okay, I still remember, way back when I used to go to the bank with my father. Okay, it was a place to be just to connect to people. Okay, obviously I'll be withdrawing 5 rupees, 10 rupees from my account, but the branch manager knew my name. He exactly knew that, where my passbook is. Okay, and they will do some manual entries. I'll get some chocolates. Okay, and that's the way banking was done. It's not something that was scalable, of course. We all know that how we have achieved financial inclusion in a massive way. How the JAM has been a really great success for bringing financial inclusion to people. Okay. And how technology adoption by India as a whole is an example to the West and to all the developed economy as well. Everybody talks in the same breath like UPI going to other countries, like the UAE and Singapore and so on and so forth. Right. But one of the things that we have really lost in this process is the personal touch, okay, is the customer experience per se, okay. And truly we have the opportunity to personal experience driven banking at scale by using technologies like AI and generative AI in specifically, okay. So I mean, just to tell you that one of the most recent product launches that we did, okay, and there's a great amount of interest for many of the customers and banks, NBFCs and fintechs that we talk about, is called Trustt GPT. Okay, so this is, this actually, it actually leverages the power of GPT, a large language model like GPT. Okay, so everybody knows Chat GPT. We all know as to how we are using it. We are using it for various purposes. But how do you leverage the brains of GPT without the corpus of GPT? Because the corpus of GPT is going to be hallucinating, and also you cannot really be having data that is not specific to a financial institution. So you need to have a database or a data graph, okay, which is very specific to, let's say, CMA's organization, okay, and it doesn't talk, all around the place. For example, it's a very popular example. I'm sure you would have come across this. If you ask ChatGPT a question, tell me 3 reasons why abacus is better than a computer. It'll actually tell you a very convincing reason. It's bullshitting, right? We all know that, but that's called hallucination. So basically the data has to be very specific to the bank or the financial services institute for whom it is being answered. And secondly, the data has to follow, the guidelines of the regulator. It has to be, locally resident. It has, it needs to be, the PII has to be guarded, and all of that information is required to be done, right? So, but to do generative AI-based, technology solution for a dedicated sector like BFSI, is a huge opportunity that we believe. And, in that, customer experience becomes the first example. For example, I mean, when you actually, the first step of that is product discovery, right? So when you go to a bank website or a bank mobile banking application or so, you are trying to find what is the best product that suits your requirement, right? And typically you are lost as a customer, okay? And it helps you to, generative AI technologies can actually, you can talk to the bank like you are talking to your friendly banker. You talk, okay? And not only you talk to the bank in English, you can talk to the bank in Hindi, in Bengali, in Oriya, and I mean, that's what, that's what we were, even the open stage, I was doing a demo yesterday of the product. So you can talk in any language that you want, okay, and you can talk mixed languages, because we all know, when we talk Hindi, we don't talk pure Hindi, right? We mixed it with English, so it's like Hingla, okay, but all of that, because of the intelligence of the large language models, it can easily, take the context from there and give you a very relevant answer, okay? So this is for product discovery. Then from product discovery, you go to product acquisition or customer acquisition, okay? So it actually takes you through the whole customer journey in a very, very intuitive manner, okay? So, if you want to take, for example, a gold loan, okay, they will exactly tell you what kind of details are required. On if you, let's say, did some mistake by telling your mobile number, you want to change the mobile number, all that variation points is very human-like conversation. But the last one, okay, there are 4 modules, okay, there are 4 products, okay, but the third one is very critical, which is all about customer service, right? Now, we all know that customer service is a big area where there are skill set issues, okay? When you have a human employee, talking to somebody, he or she may not know all the related details about a particular product, right? Their products can be having different levels of complexity to actually understand, okay? They are not available all the time, 24/7 or 12x6, whatever you want to say. They're not available all the time, okay? And the persistence that is required for you to keep following up, and the persuasion that is required, is also dependent on, the mood of the person or the skill of the person. So there is a significant opportunity to actually improve the customer service itself. I really don't want. I mean, even today, in even today's world, when you call a very large bank's call center also, they will tell you an experience which is like that, press, our options have changed, press 1, 2, 3, 4, 9, 13 to get there. And then you go to your issue, your particular, I mean, I'm already tired, okay? And the bank or the financial services institution has also lost precious time in terms of doing this. Who's gaining? But if they can jump directly to a open ticket that, let's say, I as a customer has it, and say that, okay, hey Gautam, last time you raised a refund request for this particular transaction, I'm happy to inform that the refund has been processed and your account has been credited. This is the transaction reference number. Okay, great. I mean, there's a huge chance that I'll easily be cross-sold some other solution at that point in time. So I think, I mean, the examples can be many, but really, this is a very transformative time that we are all going through. Okay, until interface to the large language models. Of course, these models have been around for for a decade, but until an interface called ChatGPT was formed, the world did not really know about it, and we all know about it right now. Okay, and I think that the ability of transforming the way we bank, that ability to transform that we interact with our service providers are going to be significantly changed. Okay, that's the potential that it has.
So thanks. Thanks for that, Gautam, and thanks for sharing the insights. And in fact, what we'll do is we'll talk a little bit, around the ethics and risk in AI. We'll also talk a little bit about how the entire fintechs versus banks partnership has panned out. But because, and I mentioned the former point because if you think about it, one of the biggest deltas in customer experience when it comes to predictive analytics in financial services, when it gets delivered the maximum to people who are so-called at the edge of financial services, right? And I was sharing this sort of insight earlier at the panel yesterday evening, and which is on the lines of the fact that only 10% of Indians today actually have a credit score. Only 10% of those who have a score good enough for money to be lent by a bank, right? And so effectively what we are saying is that the entire formal financial institutions in the country are servicing the max 2 to 2.5% of the population by formal banking services. And what is it that then we are trying to do as a company? What we're trying to do is that we're trying to go out there and create solutions using alternative data that comes from completely alternative to traditional data sets, completely alternative to traditional finance, and create scores on top of that that are essentially trying to say that can everyday behavior of customers across a range of non-financial indicators, can that really indicate future financial behavior with respect to credit? And can that open a pathway to those customers actually accessing formal credit? Because think about it, what was the other alternative experience for that customer to take credit? He would have gone to a loan shark and would have borrowed at rates typically considered to be obnoxious, right? Like 10% a month, 15% a month. So the delta in their experience has been tremendous by this sort of solution coming in. And same as what you mentioned about customer service as well, right? When you talk about customer service for us also, it's the same thing, right? Like when customers have given you a wealth of data, and you know so much about a customer that it is just unfair that we sort of go out there and give them a one-size-fits-all experience. You know so much about them that you can actually curate their experience out there and let them know that what we think is good for them, and then nudge them towards doing that. But now, what I wanted to cover is the downside of this. When you actually are doing all of this for a customer at the edge, they might not be fully aware of the kind of data accesses they have given for you to churn those models and give them those recommendations. They would not be fully aware of the implications of the privacy policies that you would have randomly ticked while filling 6 forms on a typical application. And the regulator is taking a lot of cognizance to that. You see that guidelines on data privacy, guidelines coming from Google Plays of the world, saying that, okay, this is possible, this is not possible, tell the customer this, don't tell the customer that. So what I want to briefly touch upon is, because of all of us interacting very frequently with sort of banking entities and fintechs like us who are trying to really push the envelope in terms of applications of AI, what do you think is really the risks involved in sort of pushing the envelope further and driving this AI at the edge, as what people say? So do you want to go ahead?
One thing that we started off in this AI journey, over a period of time, what we've realized is we've kind of abdicated the responsibility of decision making to them. So earlier they were just recommendation engines. They would tell us what to do and we would make the decision. But now, because it's huge data sets, so we are actually letting machines make the decisions for us. And these machines are self-taught. After a period of time, they become self-taught once a design is ready. So that's a huge responsibility that we are actually outsourcing to, models. And that kind of threw up the conundrum of, the ethical dilemma that we are dealing with. And we realized that when we, it's not just like building a typical model. We need to really get into the entire process of how do we want to handle AI. So we identified various levels of bias as an organization, and we then came out with specific recommendations for each of those biases that we identified. The first bias itself is in the design of the business model. We realized that there are few engineers, data scientists, very young guys, limited experience, are actually designing the entire model for us. So there itself you have human biases coming in, and that's when we realized that we set up something called a design committee. The design committee for our models have people cross-functional department representation. People from marketing, people from finance, people from risk, people from sales as a part of that design committee. And any model design first has to be approved by the committee before it is then put in for, even for development stage. So to some extent, the design bias gets covered there, though we are not aware to what extent, because we are still very new in the AI space, and we have limited number of resources. But to some extent, this cross-functional exposure and experience kind of mitigates the bias that can creep up, in design. The second, what we realized was just a selection data bias, which is a selection of the data which we're using to design a model. So here, we were trying to predict fraud. And so we realized that our training data set, we try and keep it small because we handle large volumes of data. We said, let's start with a particular state where we have increased instances of fraud, and then we will extrapolate the training data set to the rest of the country. So when we worked on this set, on the state where we had highest instances of fraud, and then when we extrapolated to the rest of the country and then the models are throwing out output, we realized that, the maximum exceptions were coming from that state only because the training set was so narrow. That's when we had to kind of go back to the drawing board and say, no, the training data set has to be as diverse as possible. Otherwise, we are bringing in a selection bias. And that selection bias is important because basis that we decide whether we'll actually source agents from that particular district or not. And if we are excluding agents from a particular state because of the bias of a model, I mean, of course, right now we are not, as an industry as a whole, we are not really looking at the ethical, the price to these ethical, compliance issues, but it's a huge thing. And so you are actually, we realize that we have, our models have the power to decide which agent in a particular village to give employment or not, because, we have higher instances of fraud, and so all agents from that particular district were getting excluded. So then we got into, yes, the training data set and how important it is to make it as diverse as possible in order to avoid the bias. And the third kind of bias that we realized which came in was, once the model is ready and it is working, it's constantly learning from the new information which we feed in. And if we feed in untrained data sets, then the results just become completely skewed. So we are still very long way off in actually identifying all of the areas where we can identify biases which have such exclusionary implications. But then that becomes important. So now when we are creating a model where it's called the right sourcing model, so at the time of identifying an agent who's going to serve an unbanked community, when we get his or her data, we want to predict performance and fraud. So then, you're automatically, if a model is skewed or biased, you're actually, casting an honest person as a fraud just because your model is saying so. So we are still navigating the journey of ethical the ethical biases in an AI model, and it's not as easy. But that's one area that we've realized that organizations as such has to work on it. The other is we don't have access to industry data. So we might have fraud which is skewed towards a particular state because we have many agents in that state. And that was where we started our business off. But industry-wide, it can kind of normalize some of these skews. And second, when we're looking at actually the alternate credit scoring model and identifying the credit worthiness, our data was working fine till we added the negative credit list, the negative list of locations from the industry. So banking industry has got a negative list, and suddenly our model became skewed towards that. So it's a very careful and fine line that we have to draw, especially when we work at the peripheries of the edges where people are actually getting bank accounts or even employment opportunity. An agent for us earns a sustainable livelihood in Uri. He'll not shift to urban India in search of a blue-collar job. So it becomes all the more important for enterprises like us who work on the financial inclusion space. Thank you.
And before I move to Gautam, I think that's very important point you touched upon in terms of, you're having the most cutting edge model out there, but the bias coming in because of the data that you sort of ingested, right? Because like we all know what sort of happened with Google Images in the US when, it started recognizing and tagging pictures of African Americans as orangutans, right? And the entire Google Images team was fired overnight because of that. Because again, it's essentially about what is the data that your model is really trained on, right? And that's how good it can predict. In fact, I was associated with a hedge fund at earlier stage, and what we saw is that the strongest indicator of the US stock market performance today, very surprising, the strongest indicator of the US stock market performance is the amount of butter production in Bangladesh every day, just by chance. But that doesn't mean that I actually use that to actually predict the US stock market returns, right? Now, if you'd want to do it, you can do it, but then there could be seemingly completely unrelated facts that are just correlated with each other, right? But that doesn't mean that it's an alternate data that you can use to predict that. So I think it's extremely crucial when as practitioners of and operators and companies that use machine learning, we're really cognizant of the fact that what is exactly going in, because noise in is noise out, right? And I think that's a very relevant point. But Gautam, please go ahead.
Yeah, I think, very interesting, Seema, what you talked about. You talked about design biases, you talked about selection biases, okay, and the right sourcing model in terms of how you do it. I mean, exactly the point, meaning, a tool is only as good as you use it, okay, and you need to use it for the exploratory data analysis, which is a large part of any, model building exercise, is the most critical point, okay, in terms of, what, like you said, that garbage in, garbage out, okay, so, you need to build your models with the right kind of data sets, whether it is your own data set or whether it is, augmented with the industry data set, okay, all that is extremely important to build the model per se, okay. And as far as the risk of, the biases are concerned, okay, what I believe that the kind of approach that Seema is taking, where we are still doing, something that is also human supervised. So so supervised model building, okay, is what is probably still the best, because I think unsupervised models can go really haywire, everywhere, and we don't know in terms of, so there is some amount of human supervision coming it from multiple teams or cross-functional team which really knows in terms of what are the kind of biases that we need to take it out, is something that is necessarily is to be done. Now, when it comes to credit underwriting and fraud detection, I think one of the things that people use it is the generative adversarial networks. Okay, these are deep neural networks that you use it, where you can use generative AI to generate synthetic data, okay, which is, so sometimes you may not have enough data with yourself, but you can still use these models to generate synthetic data, okay, which actually mimics in the real life credit underwriting data that you have got to a large extent. And then so there is a generator and there's a discriminator. The discriminator then tries to understand in terms of how you how far is this data really something that is real or fake, or is it like a fraudulent data or so. So I think there are techniques like this which can be used. And I mean, of course, I mean, some of these requires deep expertise in terms of or having to build teams which can know this kind of capabilities, or can inbuild such capabilities. But of course, that is where I think companies like us come in, okay, where we help people to to get there with not that much of with minimal investments that is required for to get to model building and actually implement it. But yes, I mean, machines being machines, we will have these risks, and we'll all have to be really watchful in terms of what kind of data that we input, what kind of data that we augment, synthesize data, build the right kind of models, and have supervisory controls in terms of these models to be maturing before we roll it out to production and take our business decisions in. Okay, so that will be my take on the.
Thanks for that, Gautam. And I think your point about human in the loop, I think it's very relevant. I was also sharing about this earlier that, there's one quote about Elon Musk that I really relate to, which is that the best way to do AI is to know when to not do it, right? You should always know and have that big red button that you press when you know things might go wrong. Specifically, the example being of COVID, right? Today, as a company, we lend to salaried people, and our models are fine-tuned to predict credit worthiness of salaried individuals all across the board. But when COVID happens, these are the guys who are losing jobs. These are the guys who are having salary cuts. So really, you have to make sure that your models are still fine-tuned to the new reality and still be able to sort of adjust to that. So, and that's why the human in the loop in that process is just unavoidable, at least in businesses like ours where the stakes are phenomenally high. So that's very relevant. I'll come to the next part of it, which is next part of the discussion, which is some parts on the other side of it, which is more to do with the fact that, see, today in the organizations that we sort of run, collaboration is a very key aspect of whatever we deliver as value to the customers. So delivering a great customer experience is not just about what we do. It is also about, for fintechs, it's about the partnership they do with banks and banking entities. For a lot of banks, it's also the partnership they do with fintechs out there, and combine the expertise, come with their own strengths, and deliver an almost magical experience to the customers. Neo-banking is all about that. A lot of these entire prepaid programs that you see last year used to be about that, and a lot of banking at the edge, we spoke about that, has been about that as well. In our context, for example, we have this customer journey, and we've really spent a lot of innovation, bandwidth, resources, in kind of curating that, where you can kind of go ahead and take credit on WhatsApp, because we figured if you want to really go out there and serve the tier 2, tier 3 customers in India, they bank on WhatsApp. So, and all you need, just enter your name and you'll get credit. But what is really happening in the background? We are running our credit decisioning engines, but ultimately you have banking partners powering that journey. You have co-lenders powering that journey as well, which might be people coming from very different DNA, not of executing transactions like this. But at the end, you are creating a very magical experience for a customer, because he's just come in within 30 seconds, he's got credit in his account. So really, it's a marriage of sorts happening between a lot of players in this ecosystem who are then able to deliver the kind of experience you want customers to have, right? And then really push the envelope in this kind of financial inclusion and delivering a great customer experience while at it. So what's your take on it? Because there is always this debate about banks versus fintech, bank plus fintech. I really believe it's not a zero-sum game. It is positive sum game. Everybody's to benefit. All stakeholders have come with their own strengths. But also love to hear your thoughts around that.
Yeah. Okay. Yeah. So I think see, the banks have their own strength.
Yeah.
Okay. And many of the banks are our customers. Okay. So they come from they represent trust. Okay. They represent in terms of they are regulated entities. Okay. So they're the keeper of the customer data, and they have liabilities around it in terms of what can happen if they are not compliant with the same thing. Okay. Fintechs, on the other hand, okay, largely are bringing innovation. They know in terms of how the customer experience needs to be done. Like you're saying, 30-second of loan approval that happens over WhatsApp, is something that wows them. So they're really good in terms of engaging with the customer, and so in actually, if you I mean, it just so happens, okay, this is like one of our products is a digital distribution platform, okay. The entire purpose of that particular product is to enable banks to engage with their fintech partners, okay. You know, and that engagement is done in such a way that I mean, the fintech partner does not have to have the, you know, have to go through the complexity of integrating with the bank, okay. And for the bank also, for doing one-on-one integration with each of the fintech partners is a time-taking activity, okay. So, you know, nobody wants that. So once you have done it, then whether it is an API level integration or whether it is a, you know, SDK level integration or a hybrid integration, whichever way, the partner can go live in matter of weeks. Now, which fintech partner will not like to do that? Okay, I mean, we need the, a fintech partner needs the bank because they are the, the final lender. You know, it is their book that, their GLs that you are actually leveraging. Okay, at the same time, you do not want to, you want to quickly go to the market. You know, for you, it's business that comes faster. Okay, so this is like, how do you embed the financial offering? So it's an embedded finance, where you can embed your financial offering into, let's say, so HDFC Bank, right? Okay, one of the banks that we power. Okay, now they want SEMA's organization FIA to be their partners, fintech organization, and she can go live in 2 weeks' time by just embedding in terms of the financial services offering that is there. Okay, using that technology platform. So I think this is a, and for the bank, what does it mean? They can grow their business and customer acquisition 8x, 10x time, in 1 year, which otherwise they would have probably taken 3 years, 4 years time to do so, right? So it's basically a win-win. So I don't think there is, any conflict here. Every bank wants to be a fintech. Every fintech wants to be a bank. Okay, that is what some time back people were talking about it. But I think what really works is a great partnership between the two. And we can then actually get to the customer and get those white spaces actually served, okay, servicing those. So that's what I think is the future is all about.
So I think banks need fintechs, fintechs need banks. It's about collaboration, but it's also about the extent of collaboration. So we set up banking outlets on behalf of our banking partners across the country, and the first banking client, fortunately for us, was State Bank of India. So at the banking outlet, the technology which rests is a kiosk banking technology of the bank. So where do we come in? We have built an enterprise platform in order to manage this entire distribution network. Now this enterprise platform is only as good as the data or the input it gets. So initial days we struggled because bank was also new in the model. It was just 10 years, and they were still grappling with what is the kind of data they have to share with us. But that's where by visionary banks, and in this case I have to mention State Bank of India, they shared the entire data with us. So on a real-time basis, they made the data of all our banking agents available to us on their platform. It's up to us how we actually use it. And at that time, none of the other banks, including the private sector banks, were doing that, which made a huge difference to the way, how we are able to monitor the performance of our agents, how we are able to predict fraud, and how we are also able to cross-sell. So now, basis the data that they provide to us, we built, using the savings, the transaction pattern of customers, we built an alternate credit score. And using that alternate credit score, amongst the customers of State Bank of India, we actually inform them which customers to lend to and whom not to. So at the branch level, using an alternate credit score, identifying the credit worthiness, we actually are able to inform them that yes, you can take a bet on this borrower. And that is, it's a symbiotic and mutually beneficial relationship, and it's hugely beneficial. We also have the least fraud percentages in the country. It's less than 0.0026% of our overall revenue, and that's because of the extent of data sharing that banks have done with us. In case of banks where it's a black box and we don't have access to that data, like some of the very small rural banks in the country, it's doubly difficult for us to actually predict fraud, and it's a manual process. But for banks where, they deepen the collaboration relationship and extended and said, yes, we have to leverage the agility and the innovation which is available in these fintechs. It's been a mutually successful relationship.
Thanks for that. And before you saying something? No. Okay. So, I had a closing thought, but before that, it'd be good sort of hear from the audience if there's anything that you'd like to ask. Very happy to answer that. Is there anything from anyone? I think there's one person.
Hi, my name is Shreyas. I'm from Reserve Bank Innovation Hub. Thanks for an interesting and engaging discussion. I just had a quick question to all the panelists. As the industry sees the benefits of using machine learning models, for example, as you highlighted, fraud detection cases in your company has significantly reduced. Are there business incentives to improve, say, the consideration of ethical concerns in AI from a business perspective, or is that solely the responsibility from a regulatory aspect?
No, there are certainly, a business consideration. I can give an example just on the fraud detection model. So a couple of our agents in a particular district were getting highlighted as doing fraud, and they were high value. They were earning about 1 lakh a month, and high value transaction agents. So our compliance team just blocked them. So luckily the sales team got up in arms, and that's when we decided to include sales in the entire process, and we dug deep. And we realized that the reason why the machine model was behaving in such a way was that there were a certain set of customers who were getting their payments during a particular period, and a large volume of laborers who were getting money from a particular period. So transactions just shot up during that period, which led the model to suspect that there's a fraudulent transaction happening, right? So biases, besides for exclusion, it also kind of puts stop to genuine businesses. So there's certainly a business case. Absolutely, there's a business case for us to focus on the biases. We let go of good customers, right? Alternate credit scoring model, our biases actually led to very conservative credit decisioning. Whereas if those biases was not there, we could actually take less conservative decisions, overall increasing the business for the organization.
I'll also quickly take that, and Shreyas is so Shreyas, see, I'll dovetail my answer into my previous point about us having this credit sort of a journey on WhatsApp today, right? And Shreyas, if you get a message today on WhatsApp saying that, here's 5,000 rupees, take it on WhatsApp, 99% of the times you're not going to do it, right? Because you think it's probably something fishy out there. 100%, like I'll not do that as well. But we have a very successful platform today running on WhatsApp, and people are taking credit. And why does that happen? That happens because, see, ultimately, the underlying currency in financial services is trust, and that's what banks have got big time, and fintechs have to build on that. And you build trust by playing right on ethics and telling customers that this is what is good for you, this is what we are doing, this is the data we are accessing, this is why we are accessing it, and this is what we're not going to do, this is what we're going to do. So when you do all of that, and also not tread in any of the gray areas as well, that implicitly builds trust, and people are more likely to use a trustworthy financial services platform because that India is a problem of trust deficit amongst everybody, right? And this is also what I was telling yesterday as well, that the first thought that you have when you work on a mobile platform, and this is coming from customer interviews, is that people say it's sab chore hai. Now let me try to find out who's better among them. So if you build trust right there by playing right on ethics, you actually work positively from a business development standpoint, right? And you create that sort of an image about your platform that really helps you in acquiring a lot more customers. So that's really what my takeover there would be.
Thank you.
Hello, can you hear me?
Yeah.
Hi, I'm Balaji from TVS Next. I have a question to Seema. You did speak about alternate credit scoring model. So you're recommending the banks to lend money to certain people and they go by your report?
No, so we don't do that. So we have our own NBFC. So we use it to actually make decisions for ourselves. Second, we do loan origination for banks. So where we do the origination aspect, we first run it through our underwriting engine, our alternate credit scoring model, before we recommend the borrower to the bank to keep the probability of default low. So that's what we do.
So assuming that you've recommended somebody and the bank or the NBFCs lend it to a particular borrower and the borrower defaults. So what is the accountability you assume on your recommendation?
So far, we've been doing off-book lending, which means so we don't actually have a stake or a skin in the game so far. However, we have got into recent tie-up where there's a first loss default guarantee, and it's quite a significant percentage of the overall portfolio that we have to guarantee. And so skin in the game is built there. We are largely using it for our on-book bill lending, which has just started. But what I can say is we did loan origination till the pandemic. We had 0 defaults. During the pandemic, we put a stop to the activity because one, we were not sure how the models will behave, because one-off instances completely skews the output of the model. So we went slow on the loan origination piece. Now for our own on-book lending, we have taken it up and we are using the alternate credit score.
So one last question on online, rest we'll take it offline. Have you had a model of comparing your alternate credit scores with CIBIL scores for a data set?
No, we have not done that.
Okay.
Yeah, because we've been largely targeting credit invisible customers. So subsequently, we have not gone back and checked what once you get a loan from a formal financial institution, credit history builds up and automatically they get a credit score. So that we have not, but with our set of customers, we'll be doing that.
Okay. Yep. Thank you.
So I think we should be good. I can see that we are beyond time now. So thanks everyone for attending. I think it was a great chat. Always a pleasure to do sessions like these. Thanks Seema and Gautam, and thank you so much everyone. I think it was fantastic. Thanks a lot.
Thank you all. Bye-bye. Yeah.
Thank you so much. I'd like to request Mr. Suman Bhaumik, our portfolio director, to kindly felicitate them. Our moderator, Mr. Yashoraj Tyagi, the Chief Technology Officer and Chief Business Officer, Cash E. Ms. Seema Prem, the co-founder of FIA. And Mr. Gautam, the CEO and co-founder of Trustt. Requesting all of you to kindly give a big round of applause for this amazing discussion that we had. And interactive, I must say, because yes, we did get some questions.